Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗣𝗜 𝗖𝗽. I'm joined by 𝗼𝗑 Benesocky. Welcome, Ava.
Thank you, August. Hello, everybody. Thank you so much for joining us today. We are excited to have Dan Lewkowicz. Did I say that right?
Lewkowicz. There you go. You got it.
Yeah, Lewkowicz.
Lewkowicz, sorry about that. He's Director of Investment Sales and Encore Real Estate Investment Services. So welcome, Dan.
Welcome, Dan.
Thank you so much for having me. I really appreciate it.
Great.
Fantastic. Awesome. So Dan, why don't you please start off by letting us know a little bit about yourself, your background, and your connection and interest to real estate investing, please.
Yeah, sure. So I'm the Director of Investment Sales at Encore Real Estate Investment Services. I'm a commercial real estate broker. I specialize in net leased properties and net leased investment sales. So that means that I am representing buyers and sellers of all sizes all over the country who typically own property that is leased by national tenants. So think Starbucks, Walgreens, Rite Aid, CVS. I personally do a lot of quick service restaurants. So your typical fast foods, Burger Kings, Wendy's, Taco Bell, etc. We also do a lot of volume in the pharmacy space. I personally sell a lot of multi-tenant shopping centers, and we're very active in the industrial as well as medical office spaces as well. I'm also the co-creator of a course called the 𝗖𝗣𝗜 𝗖𝗽 course, which teaches people everything they need to know to be a top commercial real estate broker. I've been in the industry for about 15 years. I got my start in single family real estate investment, purchase, renovation, and resale of single family assets in and around Metro Detroit. And over the years have transitioned really into committing pretty much full time to commercial real estate brokerage.
Awesome. Great.
Fantastic. Great. Dan has lots of years of experience in real estate.
Yeah. And just a quick question about your course. What platform is that course available on? Is it on Udemy, or do people get in touch with yourself?
Yeah. So we've been pre-registering the course for a couple months. It's going to, the go live date is actually April 2nd, but we have our own proprietary platform. It's not through Udemy or Coursera or any of that. We decided to host everything on our own proprietary server so that we would have complete control. If you want more information, you can always reach out to me. We also have a landing page for registration, which is 𝗖𝗣𝗜𝗄course.com.
Awesome.
Okay, fantastic.
Awesome.
Maybe we
Great.
can put that in the chat for
sure.
our viewers. Considering all your years in real estate, Dan, can you please explain to us this concept of triple net real estate?
Yeah, sure. So it is a fascinating concept. And I think for people in general who are, have maybe a 30,000 foot view of real estate, there's a lot of things that might make you scratch your head, but upon further examination, I think that it makes a lot of sense. So as I mentioned before, typically these properties are leased out to major national tenants. So there's a lot of security there because as an example, I just sold a tire store in Florida, okay? And that lease was backed by a company that has 1,200 locations. So if something were to go wrong with that property, with that specific store, you'd still have the guarantee of the other, 1,199 properties. So think about it like if you're renting to a single, you're renting out your home to a tenant, and if that tenant has some financial difficulties or something happens to them, there's no guarantee. The guarantee of the lease is only as strong as the person who's signing it. So we work with these large national tenants that have very strong guarantees. So that's one feature of this type of real estate. Something else that's interesting is there's a lot of different types of net lease that we can go into if you'd like, but the quintessential or stereotypical net lease is what's really called an absolute triple net lease. And the reason that verbiage is used is because the actual rent that the investor collects is net to them. So whereas if you're looking at a different asset class like multifamily, for example, you're going to have, let's say, your gross collected rents, and then you're going to have all kinds of expenses, right? You might have property management, might have maintenance, capital expenditures, you might have collections, vacancy, all different type of expenses. And then you'll have a net number at the bottom. So the rent that you collect is not the amount of money that goes into your bank account every month. In absolute triple net leases, whatever the rental amount is, that is net to the landlord. So as an example, I sold a Wendy's last week here in Michigan, and that property, the rent was approximately $125,000 a year. And that was absolute triple net. So the landlord collects $125,000. The tenant is responsible for paying the taxes for the property, paying the insurance for the property, paying for any common area maintenance. And they're also responsible for, believe it or not, the repair or replacement of any part of the property: roof, structure, parking lot, boiler, air conditioning system, et cetera, et cetera. So that's actually how triple net investing works, and that's why it has that name. And because of the stability of the tenant and the long lease term that typically takes place, as well as the fact that the rent is net to the investor, the cap rates are a little bit lower than other asset classes. But again, that's because of the stability and security of those properties.
Great, great. And obviously we can't talk about commercial real estate and not talk about the era of COVID, and I guess now we could call it kind of post-COVID, at the tail end of COVID. So even though you're discussing more of a anchor type tenant and the essential need kind of storefront locations, as you were mentioning about pharmacies and kind of these needed businesses, kind of talk to us about the effects COVID has had, and also now that being on the tail end of COVID with vaccines being out, how do you see that transition taking place? So please.
Yeah, great question. Great question. So I sold a lot of shopping centers. That was one of my specialties. In fact, the last shopping center I sold in Michigan, it closed March 31st of 2020, which was within days of when the governor shut down the whole state. That was a pretty small shopping center. There were 7 tenants. And I believe that when the new owner took possession, all 7 were closed. So, when COVID hit, I made a hard pivot into these other asset classes that you're talking about, the things that we call those essential retailers, right? So your quick service restaurant with a drive-through, your pharmacies, your dollar stores, maybe your medical office buildings, or your industrial products. So what happened was, net lease is a huge, huge backbone of our economy. Hundreds of billions of dollars flood in and out of the net lease space every single year. So what happened when COVID hit was that band of money, right, that was varied, right? It was in shopping centers, it was in the essential retailers, it was in grocery stores, it was in gyms, right? What happened was when everything closed down and they came out with this novel concept that we've never really heard of, right, of an essential retailer, all that capital constricted and got put into those asset classes like the dollar stores, like the tire stores, like the quick service restaurant, fast food that I mentioned. So what we saw very quickly was actually a cap rate compression. A lot of people were very scared what's going to happen with commercial real estate. But in those asset classes that I'm talking about, as I mentioned before, and in addition, things like industrial, cold storage, or last mile fulfillment centers, we actually saw the cap rates decline, right? Which was very exciting and interesting. So now if you fast forward maybe 10 or 12 months later, a lot of those multi-tenant shopping centers are starting to come back on the market because they went one of two ways. Either, they're dealing with rental reductions requests from the tenants or vacancies that were refilled. But we're starting to see multi-tenant retail come back slowly. And obviously those other asset classes where we saw the cap rate compression, those have become, even hotter. And really from my perspective, the market is on fire, but it's also a very competitive market. We've seen what we call a flight to quality, where investors are looking more and more at these incredibly, high quality properties that are these essential retailers that are pandemic proof, so to speak. And, as that happens, the prices have gone up, the cap rates have gone down, and the inventory on the market is getting, less and less. Properties, we list a property, it's gone in a day or two, if it even hits the market. So, in terms of that, that's really what's gone on over the last 12 months. In terms of what will happen post-COVID, I mean, really, if I had a crystal ball, obviously, I'd be happy to share that information with you. My perspective is that things like last mile fulfillment and industrial, that asset class is seeing a huge increase. I mean, in 2020, they saw a 27% increase in the number of square feet of new industrial lease signed. 27% in 1 year. That's insane. If you look across the country, there are 31 markets across the country that it's projected to see a 20% or more increase in rent per square foot in the industrial space. And some of those markets are at 35 or 40%. And obviously, as rent goes up, assuming that cap rates are going to stay the same, which they won't, they'll go down, price goes up exponentially. So, we're seeing a really big change in that industrial space, a lot more demand, higher rents, lower cap rates, higher prices. And the same thing is true in the dollar store space and the quick service restaurant space. So I'm really interested and excited to see what happens over these next few years as we get out of this.
Okay, very cool. August and I are in love with the asset class of multifamily, of course. So maybe could you let us know, are you involved in multifamily, and what are your thoughts on that asset
Yeah.
class right now?
So, my background is in single and multifamily, residential. I did make a strong transition, and at the end of 2019, I disposed of my positions in any residential property so that I could focus exclusively on commercial. I've got some interesting views, and we may or may not share those. I'd be happy to go back and forth. I think that the multifamily space is incredibly hot. I'm seeing or I'm hearing word of cap rates in certain markets that are absolutely, I would say, ridiculous. They're so absolutely low. And, the thing is that, if there's one, and there's a lot of syndications going on. So I think that it's a space we have to be careful in, because interest rates are incredibly low right now and cap rates are incredibly low in multifamily. If those interest rates creep up, right, we're going to see, I think, a little bit of a dilemma there. And, I personally believe that there is, on the other side of what I'm saying, a window of opportunity in multifamily. And that's because of what went on this last year. If you look back over the last 12 months, a year ago in March, when all of this really started, hitting the fan, the SBA allowed for a loan abatement on anyone who had an SBA mortgage. They didn't have to pay their rent. They didn't have to pay their mortgage payment. I apologize. At the same time, as those months progressed, we saw eviction moratoriums and rent abatement across the country in many markets. In fact, the CDC came out and said that if you signed an affidavit that said you were affected by coronavirus and you made less than $99,000, you didn't have to pay rent. So interestingly enough, that SBA loan abatement deferral, however you want to call it, was only in effect for 6 months until the end of September. So the end of September hits, now people have to start making their mortgage payments again, but in many markets, they can't collect rent and they can't evict. So I believe that if someone's looking for multifamily, there's almost a perfect storm brewing. As we become 4, 5, 6 months of that struggle that landlords are facing, I believe there's going to be an opportunity to acquire multifamily at a significant discount over the next, let's say, 1 to 3 quarters.
And we are opportunistic when it comes to deals. Our focus is totally multifamily. So we were wishing for numbers to kind of come down, but the more and more we look at multiple markets, the more competitive and more difficult it becomes, the more money is being pumped into multifamily. And also government is stepping in, ensuring that people, the workforce housing, the type of C-class asset, B-class asset, type of those assets are the tenants are able to pay their rent and not be evicted. Now, if that's by a moratorium or if that's by the tenants actually getting a payment and then paid directly to the landlord, is where we're keeping a definitely close eye on it. But taking a conversation back to commercial real estate, we spoke about storefront retail, we spoke about industrial. Let's talk about the office space. I was on a conversation on Clubhouse, and we were in a group, kind of everyone from different backgrounds. There was guys from mainly in the real estate private equity realm, and when the conversation came to office space, and I right away jumped in and said, hey, listen guys, when you were talking about particular asset classes, we're talking about somebody's livelihood. So it's analogous to speaking about religion or politics. So we have to be very careful in kind of assessing or giving our predictions, because somebody has dedicated their profession, dedicated their business to being in that asset class, for example, being office space. So many people in the office space believe that it will come back, that this concept of people working from the office will come back. I personally don't believe that will be the case. I believe there will be a transition, that this concept of glamorizing the working man going into the office will eventually kind of change, if not fully, partly. And even if, when you talk about real estate and you talk about data and numbers, if something happens in a small percentage, it can affect that asset class huge. So kind of talk to us about office space and what is your kind of view and predictions, and what are you seeing in the market currently?
So yeah, I think that office space is a space that I personally would stay away from, with the exception of medical office, because medical office is, so to speak, I don't want to call it essential retail, but it's essential office, right? I have an $11.5 million medical office listing right now that's under contract. I think that's a hot space. I love that space. There's a concept of what we call a sale leaseback. which is where, let's say a hospital system, a major hospital system, for example, they not only operate their business outside of a building, but they own the building too. So they own the building, they own the business. I think that what we're going to see as a phenomenon across the country very shortly is the sale leaseback of medical office buildings. And again, what happens in those situations is that the company that owns the building sells the building to a new owner and then leases back the space. So instead of being the building owner and the person that's renting, they're now just the tenant. So I think that we're going to see that across the country, and I'm personally excited for that because that's going to free up a lot of cash for these hospital systems that are frankly very cash strapped. Now, if you go to the traditional office, I think that we're going to see a whirlwind of change. Personally, I believe that dollars and cents are always the bottom line, and if you look at major corporations across the country, I believe that they've saved tremendous capital expenditures by having people work from home. And I believe that the cost of operating an office will increase. You're going to need more square footage per employee because people are not going to be happy with those close quarters anymore. And at the end of the day, when a corporation can save significantly on their bottom line by letting people work from home, I think it's going to happen. And I think that on the whole, a lot of people are comfortable and happy working from home. So I see that as it's definitely not going to go back where it was. It's not going to stay where it is. We're going to find some type of happy medium. Now, that creates a very big problem because office space is incredibly difficult and expensive to repurpose. If you think about it, when you walk into an office, it's like no other experience. You don't walk into, a shopping center or a drugstore or a retail storefront, go in a lobby, walk down a hall, go up an elevator, go into a suite. There's no other experience that's like the office experience. Therefore, it makes it very difficult and hard to repurpose. So the next question, that's my prediction in terms of what my outlook is for the office space. In terms of what to do to solve that problem, I think that some of those office buildings that are located on incredible real estate in terms of proximity to central business districts or proximity to major freeway systems, there's a chance that those will get repurposed for, I believe, a more of an industrial utilization like a fulfillment center. I think that we're going to see the same thing in multi-tenant retail in shopping centers, that we're going to see that because that real estate is incredibly well located along those freeway networks, we're going to see that being repurposed to fulfillment centers as well. Again, the major challenge there is the cost of repurposing office space because of its unique design structurally.
Got it. Great viewpoint. Unless it's fully gutted and fully reinvented as a completely residential building, for example. But yeah, just to touch on this concept, this idea of a 6-day work week and the kind of the working man mentality of hard work. We've seen what the Northern European countries are currently doing with 4-day work week, and data shows that their workers and employees are actually more productive. So this idea of working from home, most people say, hey, the idea of a man getting to work or a woman going to work to the office is just getting away from their spouse. So that could be something that the office space always solves, but also, now that people are getting used to possibly working from home and giving that option, they might end up being more productive working from home because they find it easier. But Ava was also mentioning that children.
I always have an argument when somebody has a big family and there's children running around, it could then be a negative thing for them to have to work from home because there's so many distractions. But I think,
we have a side bet. We have a side bet on this whole situation. But great to see. It's good to see the data coming out. Moving forward, so
definitely,
that's great. Talk about yourself more and kind of your involvement of how do you build your business, how do you gain potential leads, how do you nurture these leads, and how do you grow? Obviously, we've seen you on multiple podcasts. We haven't seen you, I've heard you on podcasts and seen you on multiple YouTube shows. So you're out there building this brand and building yourself. But talk to us about yourself and your business and how you're growing that, so our viewers can hear about it a bit.
Sure. So I really made a big transition because the traditional brokerage model is get in the office, build databases, and cold call. 1,000 calls, 1,200 calls a month, as many calls as you can make. And that's a one-to-one interaction, right? That's That's me picking up the phone, calling you, me picking up the phone, calling somebody else. And I don't discount cold calling is very important, especially to new brokers. However, I've kind of done my best to turn the tables. And the way that I've done that is as follows. So number one is social media presence, right? I am incredibly active on LinkedIn. I have my own Streamcast show, which is actually a in studio, professionally produced show that's on Roku, on Amazon, on Apple TV. It's called Dan on Top of All Things Commercial Real Estate. And in addition, I send out a lot of email blasts, and I'll explain what I mean by that. So, for example, I just sold this Wendy's property. So I've created a database. My databasing team actually has created a database of all of the Wendy's owners in the Midwest. So an email went out saying, hey, I'm Dan Lewkowicz. I just sold a Wendy's property located at this location. I understand that you own a Wendy's located at this location. It sold within a couple days. We had a bunch of cash offers. I would love to put together a proposal for you outlining what your property is worth. And then that email goes out to, thousands of people, very customized. And now I've kind of turned the table. Now it's not just one-to-one, it's one-to-many. Same thing with my show, right? Every time I'm on my show or I'm on social media or I'm here, a lot of people are getting that message. So the really cool thing that I've noticed is that now the table is turning. So now people are reaching out saying, hey, Dan, I saw your show. Hey, Dan, I saw you on this podcast. Hey, Dan, I saw you on LinkedIn. I've got a portfolio of properties I want to sell. And because of that, the associations that I've built, and because I've leveraged myself as a thought leader in this space, there's a certain level of trust and of rapport, which is incredible, right? And now those people are reaching out to me saying, hey, Dan, can you add an additional step of value, which is to help me sell my properties? So I've really been able to kind of, turn that, I keep saying that same phrase, turn the table around so that people are coming to me, which is ultimately what my goal was. And, that's one of the things that we teach about extensively in our course is how to leverage social media and how to build your brand so that people know who you are and they know how to find you.
That's incredible. I definitely did my fair share of cold calling, as I've been a realtor for over a decade. Stepped out of the business to solely do CPI Capital, but good for you. You can touch a whole lot more people on social media. We know your presence online; it's fantastic. So good for you.
Where we've connected, we connected on LinkedIn.
On LinkedIn, yes.
It shows about your presence. I would like to bring the conversation back about this concept of syndication that you touched on. As everyone kind of knows, and if you don't now, we are syndicators. We are real estate syndicators, in our case, apartment syndicators. The concept meaning that syndication is when you bring two groups together, one being the knowledge and the background and an experience, and the other group being the capital, and together you guys complete certain project. Now in the real estate game and in the apartments and in the apartment kind of multifamily spaces, finding deals, managing deals, renovating and upgrading projects, and then the investors or limited partners who come on board, and together we kind of get the projects on. That's what basically on a high level is what we do. Now talk to us about syndication in commercial real estate, and in particular storefront retail space. Have you seen those types of assets being syndicated, and are you personally kind of in touch with any groups that use the syndication model to purchase these assets for their groups?
Yeah, sure, absolutely. In fact, I just got off a call with my accountability partner, and that's all he does is syndications. Now they happen to be kind of contrary to what I'm saying. They're long on suburban office. So they do syndications specifically with suburban office. I have a good friend and colleague who I've done a number of deals with, who created a syndication for single and multifamily here in and around Metro Detroit. And now he's stepped out into the triple net space, and we're starting to syndicate some pharmacy deals. So we're looking at Walgreens and CVS's that have 7+ years on the lease, because then we can get 25 or 30-year amortization, and that allows his cash on cash return to go up significantly. And we're putting together syndication deals that way. So yeah, syndication is great. There's, on my show, I've interviewed some top syndicators, and they all say the same thing, which I'm sure you guys will echo, and that's that syndication provides a tremendous value to the investor. A lot of these investments are out of the reach of a single investor. If we're talking a $4 million apartment complex or a $4 million Walgreens, many people would have 100,000, 200,000, 400,000, but maybe not 4 million. So it enables people who have, less capital to have partial ownership of an asset. That's number one. Number two, it's completely passive, right? So people like you guys or like myself can get our hands dirty, have our boots on the ground, and the actual investors are the ones that are passive and are collecting their rental checks. And number three, it allows experts to focus on what they're doing. The passive investors don't necessarily need to be experts in a specific asset, right? But they need to trust experts like yourselves. And then another thing is diversification. If you're investing in a syndication that's a portfolio, now not only did you not have enough money to buy one of those assets, but you're now owning a certain share that's segregated, that is kind of like amongst an entire aggregate of multiple assets. So yeah, it's a great concept. A lot of people are very fond of it, and I love working with syndicators, especially those who are good at what they do and understand their asset class and their industry.
Great point. Great point. All right. You have some other questions for our friend Dan here?
Absolutely. You know what? I was going to tell him I was listening to him on the 𝗖𝗽𝗶𝗁. I was going to bring up this 1,000 calls a month you made, but I love how you transitioned into what you're doing now. That's fantastic. We ask every guest this question, and it would be, what would be your number one best advice that you would give to a passive investor?
Number one best advice to a passive investor, I would say, is, do your homework. So your homework includes doing your homework on that asset class. You don't need to be an expert because you're not the one doing it, but become as much of an expert as you can so that you understand the nuances, right? And that might mean working with a broker who's going to help you, get to know that asset class and how to underwrite it. And then, the other thing is make sure that you work with people that you trust. Make sure you get referrals, make sure that you get resources, and make sure that, you understand who you're working with, because ultimately, you need a lot of trust. There's a lot of great people out there that are doing this, and there's a lot of not so great people out there that are doing this. And keep in mind, your investment is still just that. It's an investment, right? It might do very well, it might not. But at the end of the day, you need to make sure that the people that you're working with are easy to work with and that they're trustworthy and honest. Those are the most important things, because, you have to look at them as the captains of your ship. They're there to bring you a profit, and you need to make sure that you trust them and that there's transparency and that you're able to work well together. Ultimately, those, I believe, are the most important things.
That is the
Amazing.
Greatest advice.
Awesome. Hey, we really appreciate your time, Dan. We'll wait on the line here for a bit after the YouTube show is complete to answer some questions, but we really appreciate you coming on. We'll hope to have you on again as this space of commercial real estate transitions into somewhat of normality. And thank you so much.
Yeah, we really appreciate you.